The third biggest company, Dr. Pepper Snapple, which is a lot smaller, and the one after that is Schweppes, which is a lot smaller still, or Monster Beverage. So Coke and Pepsi basically control the soft drinks business. Essilor and L'Oreal, both of which we own in the portfolio, control makeup and cosmetics. There really almost isn't a third player. Maybe the third player was Revlon, who've just announced that they're going bankrupt. But those two control all of the main makeup brands. We like escalators and elevators because of the servicing business. You came up in a Coney elevator. We own Coney, actually, which is a Finnish company. The other big ones are Schindler, Thyssen, and Otis. But that whole market is really controlled by those four companies. So, the cloud is controlled by Apple, Microsoft, and Oracle. We tend to like these areas of endeavor, which have two or three giant players, because they found a way to keep the competition out. So that chart just shows you that when I said at the beginning, we only invest in good companies, we're trying to support that and prove that by showing that on these sort of financial metrics, these are better companies than the average. I put the slide up because the third piece, rather, as well as buying good companies and trying not to pay, trying to pay the right price for them, the hardest thing we think to do if you have a portfolio of 29 stocks is to do nothing. It's very difficult to start the year with the same 29 stocks that you finished the previous year and then hold them for another 12 months. Because there's this imperative in financial, in fund management, which says you make money by switching out of something and into something else. And what we're trying to show on this slide is with 29 companies in the portfolio, 2020 was a slightly strange year because of COVID. And so we got the opportunity to buy 4 stocks that we'd wanted to own for some time at a significantly cheaper valuation than they were usually trading at: Nike, Starbucks, LVMH, and Church & Dwight. And we sold 2 stocks against that. In 2021, we sold 2 stocks we sold 4 stocks and we bought 2, Amazon and Alphabet. And in 2022, so far this year, we've sold 2 companies, Starbucks and Johnson & Johnson, and we bought 2, Adobe and Mettler Toledo. Adobe, you probably all know because of digital publishing. You probably use it every day. Mettler Toledo, you may not know, is a weighing company. So when you put your bananas on a weighing machine in the supermarket, that might well be a Mettler Toledo machine. Everything coming out of factories needs to be weighed and measured accurately. And Mettler Toledo is sort of the market leader in that. We've wanted to own it for a long time, and we got the opportunity to buy it. You can also see on that chart, you sort of get an idea of the sorts of things that we own: very large healthcare companies, as I mentioned, large consumer companies, and then some of these old line technology companies like Microsoft, Amazon, and Alphabet. So we try hard to do nothing, but we do sell a position, even though when I said at the beginning, we're trying to own these things forever. We will sell a company for one of 4 reasons. Either it's taken over by a company that we don't want to own, or it gets incredibly expensive and we think we can get better value elsewhere, or it just doesn't do a very good job at what it is that we want them to do, or it changes what it's doing in such a way that we're not happy with the new business. So if you look at 2021, we sold a business called Becton Dickinson, which is a huge healthcare business. It makes the biggest maker of syringes in the world, for example. And we liked that business very much, but they became very acquisitive and they started buying other companies. And we don't like our companies buying other companies because we feel that ultimately destroys value. And so we sold that. We sold Sage, which is the company above it, which is in small business software, because we also own its competitor in the US, which is called Intuit. And Intuit is doing a much better job than Sage. So even though we like small business software as a business, there's some issue with Sage that we couldn't work out. And we decided that while they were getting over this issue, whatever it is, where they're underperforming their biggest competitor, we should watch from the sidelines. We have 29 stocks in the portfolio. We are watching 76 companies, I mentioned at the beginning. So we've only found 76 companies in the world that we think are good enough to buy and hang on to. We have 29 in the portfolio, split almost evenly between healthcare, technology, and consumer. The 29 stocks is because we think that funds that have more than 30 stocks can't really make their mind up. There's no diversification benefit of owning anything more than 29 stocks. We're investing on a sort of 7 to 10 year view. We hope that all of our investors are invested on a similar time frame. Now, in that period, given what I showed you earlier on about owning higher quality businesses than the market, we would hope that we would produce a better performance than the market because we just flat out own better companies. But there will be periods within that 7 to 10 year time horizon when what we own is not particularly popular. And at the moment, what's going on, just to talk briefly about the current environment, the only sector that's done well in 2022 is energy, which we don't own. We'll never own an oil company in our portfolio, but the oil companies have all done very well because of the spike in the oil price. That's about the only sector in the S&P that has done well this year. Any fund that doesn't own energy will be underperforming the index. Now, we are not greatly concerned about periods where the share prices of our companies are going down, so long as the underlying businesses are fine. And all our analysts at Fundsmith do is spend the whole day reading and writing about the 76 companies that we follow and the 29 in our portfolio to make sure that their businesses are all doing well. If the businesses are doing well, we don't really care about the share price because the share price is a much shorter term measure of so-called quality. Whereas what we're investing in is a long-term cash generative global mega cap company that has some way in which we think it can grow over the next 5 to 10 years. And we don't expect the share price of that company to go up every day, every week, every month. We just think that if we can promise our investors, and we do, that all the 29 companies that we own today are bigger today than they were yesterday, they will all be bigger tomorrow. And we know this because we know their cash return is above their cost of capital. And we know they're taking some of that cash flow, reinvesting it back into the business at these high rates of returns. That's how they're compounding. So even if the share price, is reflecting market malaise or the fact that the whole world might be about to go into recession and other things, it's painful as an investor to watch that. But so long as you don't need the money today, there's nothing about Nike that we don't like today or we like less today than we did a year ago or 6 months ago. All of the 29 stocks that we own, we think are great businesses growing today, growing this year, whatever happens, compounding. We think they will all be significantly bigger in 5 years. And so if we can be patient and just hold on to them, we should be fine. We should be fine. And that is the sort of Fundsmith philosophy. We don't worry about short-term market movements. We worry greatly about the 29 businesses and whether there's anything going on in the world that is changing our assumptions for those 29 businesses. And so far in the portfolio, so far in 2022, there isn't. I mean, the only thing that our companies have been talking about in the last couple of weeks is higher input prices, so we own McCormick, which is in spices. When you go to the supermarket, they have the sort of expensive spice rack in the nice jars, and then they have the sort of tins, which are a bit cheaper, and then they have the sachets at the bottom, which are very cheap. And McCormick makes them all, essentially. It has about 80% market share in the US in supermarket. And it did very well through COVID because everybody was cooking more. And it's been doing well post-COVID because all the people who learned to cook during lockdowns are still cooking at home. So it's a great business. It's not very cyclical. They had some figures 2 days ago, and they just said we're having to pay more for raw materials, and we're having to pay more for the shipping of the products, both the raw material and the finished product, which we know about. But again, going back to that slide I showed at the beginning, if you have a high gross margin business, it can afford to spend 5, 6, 7, 10% more in input, or bear an input price that's 10% higher. Because its gross margin is so high, and it can still make money and still grow and compound, even with that higher price, because of its higher gross margins. So moving on, this just shows you the sector split that we currently have. This hasn't changed very much, but it's roughly what I was saying a moment ago. The consumer staples make up 30% of the portfolio. Technology makes up 27.9, although communication services should probably be included in that. And then healthcare makes up sort of 22%. That has been very steady for the last sort of 5 years, and it hasn't really changed much. In terms of geographical split, we are heavily weighted towards companies which are listed or headquartered in the USA. This is not because we've taken some view on the US economy. It's not it's not because we have a macro view that that's a good thing to do. It's simply because if you look at the best or biggest companies in the world in consumer, technology, and healthcare, they all happen to be based in the US. Over on the right-hand side, you can see where the portfolio as a whole is doing business. So it's much more evenly spread in terms of revenue. So we're not just investing in US companies doing business in America, we're investing in Microsoft doing business all over the world. And that comes out rather more clearly on the right-hand side of that screen. I'm going to go all the way back to the beginning just to show you what the fund has done so far this year. So the fund, this is to the end of May, in sterling was down 15, the market was down 6.5. I hope that you might look over on the right-hand side of that slide in the third last column, the annualized return, which shows that the fund has produced a 16.2% return against the equity market in general, has produced an 11.8% return. And the only reason that we can give for producing a better return than the index is that the first slide I showed you, which is that we believe we own better products than the index, better companies than the index, which are growing and compounding at a higher rate. And I was just going to show that this slide doesn't add much. It just shows you which companies have worked well this year and which ones haven't. The only one I was really, I mean, I can talk about any of these, but the only one I was going to mention is Novo Nordisk, which we bought. We don't really like big pharmaceutical companies generally because they're always out to try and find the next big blockbuster drug, and mostly they can't find them. So we don't feel it's a very good area to invest in. An exception is Novo Nordisk, which we bought because it makes insulin. Unfortunately, if you have diabetes, you have to take insulin. Once you start taking it, you can't stop taking it. But they had an interesting thing that happened last year, at the end or middle part of last year, which is they have a new insulin which they've just come out with, and that there are two side effects. Firstly, it helps cardiovascular patients or patients suffering from cardiovascular issues. Secondly, more importantly, the people taking the new insulin lose between 11 and 14% of their body weight. So it's actually this drug with no side effects is becoming a weight loss drug. And you know, why wouldn't they market it as that? It sort of makes sense. Now, that's not why we own it, but the price is doing very well this year because I think people are waking up to the idea that particularly the US obesity market is enormous, literally, no pun intended. And, you know, Novo should be able to do very well with that. You know, McCormick's done well this year, Visa in payments, Stryker is orthopedics. I'm sure you know Amazon in sort of retailing, although it's not really much of a retailer anymore. On the right-hand side, just mention a couple of those very quickly, PayPal and Meta, the big highly rated tech companies in the US have not done very well this year. People think that because of recession or higher interest rates and or higher inflation, that just demand in general is going to slow. It also affects the valuation of the equity market because of the discount rate. And so highly rated tech stocks have had a difficult year so far. Intuit is in small business software, which is actually doing fine. Estée Lauder I mentioned earlier on. IDEX, just in case you don't know that, is in veterinary testing. It's the largest manufacturer and supplier of the consumables that go into vet's office. So the veterinary testing is more advanced than human testing because your cat can't talk, and nor can your dog. So when you go into the vet and he or she takes a tiny little sample, and then they put it in the machine in the corner, and instantly they can give you a diagnosis. All of the consumables made in those machines are really IDEX consumables. And actually they did very well through the pandemic, funnily enough, because people were at home with their pets much more than they were usually. So when the pet coughed, they thought there's something wrong with the tiddles, and so they took it off to the vet. So IDEX had a very strong lockdown, which is possibly why it's doing slightly less well this year. I think I'm going to stop there. Well, maybe what I'll do is I'll just say one thing about sort of the environment that we're in. We at Fundsmith don't take a macro view, which means we don't invest on the basis that we think we know what's going to happen in the world economy. The reason we own these 29 companies is because we can show that they can make money even at the depths of a recession. So long as we can promise to you that they are growing and compounding every day, whatever's going on in the world, then we feel that this fund is worthy and people should be in it. So if we only own things that we know can make money even when there's a recession, then obviously we worry a bit less about a recession than other managers that own cyclical stocks or those that are very highly rated or those that haven't yet found a way to grow. So we at Fundsmith don't have a particular macro view. Having said that, we do get a window into what's going on in the world from our companies as they are reporting. What they are generally reporting at the moment is they still have very strong demand, which is a kind of a mystery to somebody with a small brain like me, that there still seems to be an enormous amount of money washing around in the Western world, particularly in the US, where I've just been actually. And New York was crazy busy of people spending money. And I was in London 10 days ago, and our office is just by Oxford Street, and the shops are packed and people are walking out with bags and bags of stuff. So I've got a quote from the CEO of L'Oreal, which he from last week, and he said we'd see no change in the beauty market so far in 2022 than what we saw in 2021. Now, I understand that as interest rates keep getting pushed up by the Fed, that demand has to slow at some stage, and they're going to keep pushing interest rates up to try and curb inflation. And when people's mortgage rates are going up, they're not going to spend as much money. So I get all of that, but it is, if the US does go into recession, it's going to be a slightly unusual recession, because it's probably not going to be because of demand. Most recessions are because people are not spending money and the demand dries up. But this is going to be more of a supply recession, essentially, because you can't make the products fast enough, and they can't be delivered fast enough. So it is a kind of a strange situation that we're in, but we think our companies are doing fine at the moment. We also think our companies can absorb a quieter 2022 or a reduction in the growth rate or even a recession without too much trouble. And given that we own these businesses for sort of 7 to 10 years, even if the rest of 2022 or early 2023 is difficult for them, again, it's not going to cause us a great problem, because we want to own them forever, because we think they are that good. And because we know that intrinsically they're all growing. It would be a different story if I said to you, I think our 29 companies are all going to shrink a bit in the second half of the year, but we can't really be bothered to sell them and just hang on and it'll be okay. But we're not saying that. We think that they're actually going to grow in the second half of the year. We don't know what their share price is going to do, but the companies are going to grow. And if they are going to grow, we think the right thing is to stay invested in them. That's about all I can say about macro, I think. Do you want to ask me some difficult questions?
I don't know how difficult they are, but
have I left anything out? Is there anything you'd rather you wanted me to?
No, I think it'd probably be revealed in the questions themselves.
Okay.
I think a lot of these are kind of macro-ish.
Well, they'll be very short answers.
Yeah.
Let's do that. Yeah. Then we can have a drink. It'll be fantastic.
Absolutely.
It'll all be over in 5 minutes.
Yeah. So of course the number one question is, who's going to win the war? So
It'll I have no idea. Next.
It's going to be a draw.
Yeah, it'll be a no score draw. I have no idea. No idea.
Okay, so I think you've covered it a wee bit, but the first question is, what is Fundsmith's view on the current global economic environment, and will you recover losses by the end of the year?
Well, if the answer to the first bit, what's our view? I mean, it's worth saying that Terry Smith, who runs the fund, has been very sort of bearish about the world ever since 2008, actually. I mean, he doesn't think that we've really solved the problems of the world financial crisis. And central banks just throwing money at the problem in quantitative easing is not very good. It's not getting the patient to recover. It's just feeding medicine to the patient to keep it propped up. Yeah. So that's why debt levels have gone through the roof, government debt. And so he's never been very positive about world economy or about the stock market since we started Fundsmith in 2010. Now, obviously, the fund's done quite nicely, the market has done very well, but luckily we don't invest on the basis of Terry's macro views. Sure. But he thinks that we're in this situation where the Fed's going to have to go on putting rates up, and ultimately that has to choke off demand. Interestingly, when people were talking about wanting inflation 2 years ago, he had an analogy where he said, trying to create inflation is a bit like lighting your barbecue. You put a bit of fuel on and nothing happens. You put a bit more fuel on, nothing happens. By the time the match actually takes, the whole thing kind of blows up. And that's slightly what we're seeing now, where inflation's, out of control, and they're too late trying to address it. Yeah. So none of that's particularly good in a sort of global macro sense. But two things to say. One is, it doesn't affect what we're doing. People are still going to look at their photos, which are stored in the Microsoft cloud, and they're still going to buy cosmetics and still going to buy dog food. So it shouldn't affect us terribly much. The other thing is, it's worth remembering that the stock market is a discounting mechanism. It always looks ahead. So I have no idea how far ahead it's looking.
Sure.
But you could say that it now thinks there's going to be a recession. Rates will eventually come down, inflation will come down, and we'll come out of the other side of it. I don't know, maybe this time next year. So you think, well, if the market's thinking 12 months ahead, what do you think it's going to look like in July of 2023? Might be quite a good situation. You know, everybody might be quite happy again. So I've no idea is the answer.
Okay, fair enough.
Idea.
I think that's.
Oh, the second part was, will we recover the losses?
Yeah.
No idea. I mean, I have no idea. We own these businesses because they're great businesses, but getting us to predict what the share price of any of the individual ones is going to do, no idea, no clue.
This one's along similar lines. If markets anticipate a recession, they typically fall circa 20%. The S&P 500 is along those sort of lines, with Fundsmith, 15% down.
Yeah.
More pain to come?
Don't know. I mean, but that's kind of roughly why I was saying it's a discounting mechanism. It's thinking in the future. You know, I think the mistake that some investors make is they pick up the paper in the morning and it mentions the word recession. And they think, oh my God, I'm the only person in the world who thinks this might happen.
No,
but I mean, the stock market's trying to think way forward. It's trying to think which of these companies is going to come out of recession strongest, such that we would buy them now. But specifically, I mean, it's impossible to say.
Well, that leads to the next question, which is where do you see the opportunity? Where does Fundsmith see the opportunity?
Well, I mean,
in the doldrums.
Well, the answer to that is that we invest in new, not new, but new positions for us, new companies for us at times where we get an opportunity. So in 2020, it was before the slide was put out, but in 2017, we owned Clorox, which makes bleach and pet litter. It's not the most exciting company in the world, but there was a bid for Clorox. And so the price went through the roof when we owned it. And at that same time, L'Oreal had some small issue, which meant that L'Oreal and Clorox were trading on the same rating. And so we just said, this is mad. A bleach company can't trade on the same valuation as a fantastic luxury goods sort of stroke cosmetics company. So we switched one into the other. So to some extent, what we did in 2022, we wanted to own Adobe and Mettler-Toledo. We've wanted to own them for ages, but they've been too expensive. And so the opportunity for us when the market comes back is something that we've had our eye on for a long time. We can buy and start a new position in. So the opportunity set is within the 76 companies that we've been looking at every day for the last 10 years. It's not some new, we're not going to rush out and buy a bank or something.
Yeah. So you've always had them in the drawer.
Yeah. Always wanted to own them. Yeah. And now we get the opportunity. So we're very happy about that.
Perfect. And in terms of the luxury brand holdings, are you going to add to those?
Maybe.
With their superior margins?
Yeah, I mean, well, so LVMH, Louis Vuitton Moët Hennessy, which we bought, as you can see, in 2020, we didn't really think we wanted to be in luxury goods. Well, it's partly because Fundsmith's run by slightly older English guys who certainly don't understand fashion. So at least Terry knows what he doesn't know, in a sense. And we thought that luxury goods, A, there was a fashion component to it, and B, we were worried that it was cyclical and that when things turn down, people don't really spend money on expensive kind of things. And we were wrong about that. It's luxury spending is very steady. And you saw that through COVID. LVMH actually had a very strong period during the 2 lockdowns, which sort of makes no sense, but I guess people are buying things online. So we bought that and we really like it. We do have, some luxury through Diageo in spirits and then L'Oreal and Estée Lauder in cosmetics. But we could, our smaller cap company, Fundsmith, owns Moncler, that makes expensive ski gear. So it is something that we could expand in. Yeah, I mean, we've only become comfortable in the last 2 years owning anything in luxury goods. So it's something that we could put more money into. Yeah.
Shiseido versus Estée Lauder?
No, it's not. The returns are not high enough, unfortunately. We have had a look at it. In fact, we haven't had anything in Japan. There's no Japanese company, and there are plenty that compete directly with things that we own.
Yes.
And we can't find a Japanese company where the returns are high enough, and where we think the management is only engaged in trying to make money for shareholders. That. Be careful what I say. That's not always the first thing that the Japanese management wants to do.
Sure.
So we do look at them, but we haven't found a Japanese company we could buy. The financial metrics are not good enough.
And what are your comments on the Japanese yield curve control? That seems to be ridiculous.
I don't have any comments. I mean, because it's just not in our wheelhouse.
But it's like the antithesis of what's happening across the pond.
Yeah. But Japan's a very special and interesting place, and I think that people somewhat forget that it's not like anywhere else. It's not even like the places that are close to it geographically.
Absolutely.
It's a completely separate way that they live and work and do everything.
Yeah.
And I think it's a huge mistake that we in the West think that we spot opportunities, there, but without knowing really how it is that they do what they do. And they're to be applauded for what they do, but they're very different to the rest of the world.
Okay. Very straight down the line. What does Fundsmith do to mitigate risks and further losses?
What do we do to mitigate risks and further losses? Well, I mean, I think what we do is we try and tell people what we do, and then it's up to them. If it doesn't work for them or they don't like it, totally understand that they can either sell the fund or they can go and buy a different fund. But what we in the fund are not doing is we're not selling stuff and sitting on cash and thinking we're going to get an opportunity in the future to buy our companies cheaper. We at Fundsmith have this expression that we think there are two types of market timers. Market timer being defined as somebody trying to play markets by getting in low and selling high. So we think there are two types of market timers: those that can't do it and those that don't know they can't do it. There's no third category. We've never met anybody who was able to do it over any length of time. So at least we know we can't do it. Yeah. So also, given what I was saying before about the fact that we know that L'Oreal is bigger today than it was yesterday, Wednesday, it'll be bigger on Friday. We think that the risk is being out of it, not in it. So, if we sell it today and just hope the share price is going to go down, if the company's growing, the share price might just go up from here. We'll never get back in. So there's nothing specific that we do in the portfolio to mitigate risk other than the fact that we have somewhat of a broad spread of stocks within the 29. But in the current environment, if the question is aimed at, are we buying puts on the market, or are we going to cash or something, or moving into utilities or buying energy stocks because they're rolling, the answer is no. Nothing changes at Fundsmith.
Do you think high market valuations are a direct function from ETF misallocation of capital?
No, I don't think so. I mean, ETFs, for those that don't know, are quasi-index funds. They're really index funds, but there have been enormous flows into index funds in the last 3 or 4 years. I don't think that has caused valuations to go up. I think the reason valuations are high was because there's nothing else to invest in. You can't buy bonds if your bond's yielding nothing, or 0.1, or
next to nothing.
Next to nothing. And if you can't buy bonds, it sends you to the equity market. I think there's quite a lot to be said for index funds. Actually, for many investors, it's the right way to do it. But I don't think ETFs caused a sort of, or misallocation of ETFs, or whatever the question was. I don't think that caused prices to go up. Prices went up because the economies have been very strong in the last 10 years, and because you couldn't invest in bonds. So, you had to be in the equity market.
Okay, and underlying companies you invest in,
yes,
can they really deal with the higher rate environment?
Yes.
Sustainable. Whoops.
That was God striking me down for that answer. Hang on. No, I can do this. The answer is, the question is, can our companies deal with higher interest rate environment? Well, yes, for the reasons which I hope I showed on the first slide. If they've got high gross margins, then don't forget that most of our companies are very cash generative, so they don't borrow very much. And so it's not like they're going to get killed by their borrowing costs going through the roof. A. B, they have high gross margins, so they can absorb some of their input costs going up. C, the average start date of the companies we currently own is 1928. So they've seen all of this many times before. Again, I think there's a recency bias in us as investors. We think everything happening is happening for the first time and we need to panic. But for these huge companies, they've seen all of this before. They've dealt with it before.
Sure.
And so they will find ways around it, and they'll deal with it. And if they don't, the worst thing that happens is their gross margin contracts, from 60 to 50, 6 or something, so it's not the end of the world. So
Sure.
yes, I do think they will deal with it. I mean, this is partly where the rubber hits the road. We've spent the last 10, 11 years going around the world saying to people, we only invest in great businesses that can make money, whatever's going on in the world.
Yeah.
Well, we're about to find out,
Yeah,
but we're
absolutely.
pretty comfortable with what we own, given what they're saying.
Okay. Joe, I think this goes to your timing answer already, but I'm going to throw it out there anyway. Some fund managers converted to cash in Feb and then are buying back in at lower values.
Well, congratulations to them. Well done. Well done. We were lucky enough to be stockbrokers for, I don't know, 35 years or something. We went around the world. We saw all of the great and the good fund managers around the world. We never met anybody who could market time consistently. It's like hedge fund guys. Hedge fund guys make a huge profit on something, and then they become a guru on whatever it is. And then, the next year they're down the amount that they were up the previous year.
Sure.
It's very, very difficult to work out. You're not working out where the market should go. You're working out what other people think about the market and what they're going to do about it. It's an agency. It's your 3 stages attached. It's incredibly difficult to work. Even if I could give you next year's papers, if I could give you the 1st of January, 2023, and you could read what was going on in the world, it would still be very difficult for you to beat the market, even within the information, because you've got to guess what other people are going to do. Why did the market go up during lockdown and COVID? It didn't make any sense. After it went down in March, went rocketing up in April when everybody was locked at home. It didn't make any sense. So people who can really beat the market consistently over time by trading in and out of their portfolios, good luck to them, but it's just not what we do. We know we can't do that.
Okay, clear. What's your view as far as the bottom of the cycle, given where the Dow is at the minute?
When the bottom's going to be? I have no idea. But I mean, I was on a call with a sort of strategist who came out with this great line, which was market always bottoms in May or October. And I just thought, what a great sort of thought. I mean, he had no view on whether it was going to be May or October, or why it was always May or October. So I think my best answer to your question is either May or October.
That's a good one. I've got to remember
I've got
that.
no idea. Is the answer.
Similar lines, are the markets oversold at this point?
I define oversold. I don't know what that means. I think every day the market reflects, moderately accurately, because if you believe in the efficient market theory, the day when the market closes, everybody is happy with the price where it is, because if they weren't, they'd be in buying it, or selling it. So if you believe in efficient market theory, the market's exactly where it should be today. So it's not oversold or overbought. If the question is, has it come down enough? Is it going to bounce back up again? I have no idea is the answer. But I'm happy owning shares of L'Oreal, because that means I don't have to care about whether the market's oversold or overbought.
Fair enough. Why does Fundsmith not own 10 shares in China?
The reason we don't own any shares in China is because Terry used to run, when he was running Collins Shire, which is a big securities business, and then he ran Talit Prebon. They had operations all over the world, including offices in China. From owning an operating business in China, he's very suspicious about owning an operating business in China. The things that we are suspicious about are, firstly, we need to know that the numbers that we're getting from our companies are good and audited, and that we can verify them. And we do not believe in all cases that Chinese companies are giving you numbers that can be verified and audited. So that's a problem. The second problem is, Western companies doing business in China risk all their IP being stolen, because that's generally what happens. So that's not great. The third thing is that the way that you can invest in China at the moment is you're buying units in Hong Kong, which might give you the right at some stage in the future to something which in itself might be headquartered in Geneva, but apparently it's a Chinese business. And the problem with all of that is, if the music stops, are you really going to is your bit of paper going to get you some piece of that company? It seems unlikely to us.
Not sure.
So for all of those reasons, we don't mind our companies having operations there, but they're operations they can get out of quite quickly if they need to. But in terms of Fundsmith Equity Fund, owning shares in a Chinese company will never happen.
Okay. Clear on that. I think you've answered this, but I'll throw it out there. Why has Fundsmith fallen further than the MSCI? Is it just energy?
Yeah, because the energy sector is up 30% this year, the S&P energy sector. And any fund that hasn't got, a big weighting in energy will have underperformed the index. It's a very general comment, but it's pretty much true. And energy is not something we can invest in. We won't invest in energy companies because oil companies, energy companies are to some extent slaves to the underlying commodity price. So the oil price will go up or down. We can't predict that. Their profitability varies enormously depending on where that oil price is going. If you can't predict that, then we can't invest in it, because we can't say to you, I'm so sorry, we bought that, Exxon, but it hasn't made any money for the last 3 years because the oil price has gone down. Because, well, you're an idiot, you shouldn't have done that. So energy doesn't work for us in this strategy, but any fund that doesn't have energy will have underperformed the index this year. There is another reason, which is, we do own Microsoft, Amazon, Alphabet, PayPal, and those were highly rated sort of tech companies.
Yes.
They are less highly rated tech companies now, because as soon as people think that growth is slowing, and as soon as interest rates go up, so the discount rate, the risk-free rate goes up, equity valuations suffer accordingly. And so the higher rated things come down. It doesn't concern us greatly because none of that affects Alphabet's business or Amazon's business, but in share price terms, it clearly is, one of the reasons why we've done less well than the index.
Yeah, sure. What would you think the discount to NAV is at the moment?
But in Fundsmith?
Yeah.
No, we trade at NAV.
So you're at NAV?
Yeah. Yeah, there's no discount.
So your view on fintech companies?
Well, it's just not something we'd invest in. I mean, we won't invest in financials anyway. We won't invest in banks or any financials. Fintech is a subset of that. There are companies within Smithson, the mid-cap firm, which don't quite fit into fintech, but they are closer. But it just doesn't work. We can't find companies with the right financial metrics that have been around for a long time. So we need to look at companies that have been through several market cycles before we're convinced that they can make money even in down economies. And the thing about the whole fintech sector is it's comparatively new. So what might happen is one of the fintech leaders will become a bit dull and boring, and that's when we buy it. So when we bought Microsoft in 2013, everybody said, God, it's so boring, it's not Apple, and everybody hates the Surface, and nobody uses the phone software. And that's why we're buying it. It's really boring, but it's growing. Sure. It's not a kind of shiny, exciting new thing like Apple. So I think fintech just fits into a bit too new and exciting for us.
Let me rephrase the previous question.
Okay.
So is there a view on the value of Fundsmith's current portfolio relative to the market value?
Well, so the only way I can really answer that is the free cash flow yield, which is the way that we measure value, if you like. That's how we value the portfolio. The free cash flow yield today is about 3.7. When we started the fund, it was just under 6, and it's been as low as 2.5. So now the reason that's important is because we think the return the fund should produce is free cash flow yield that it's trading on, added to the growth of the free cash flow. Now, the free cash flow growth on average for the last 10 years has been 8%. So if you add 8%, 3.5, you get 11.5. We're not allowed to give projections on what the fund is going to do, so I'm not projecting, but I'm just saying, if you were to tell me, mathematically, what should this portfolio produce now? The answer is it should produce a return of, we think, of about 12% a year, 11.5%, 12% a year, which compounded as an equity return in high quality businesses, we think is pretty decent. Yes. Also, 3.5 free cash flow yield is somewhat close to what the long bond should be yielding.
Yes.
And if you can buy a high quality equity portfolio, which is growing, isn't that a better trade than buying a long bond on a similar yield? We think it is. Yeah, so absolutely. From that point of view, to answer the question, we think that's quite an attractive combination at the moment. It was, in pure valuation terms, slightly less attractive at the end of last year. But as we're 7 to 10 year investors, we were fine with that as well, because we thought, well, there'll be a period where, this might underperform for a bit or the prices will go down. But there's everything to like about the 29 stocks that we own for the next 10 years.
And final question, unless there's something from the floor, is there something everyone else? The final question, do you agree with Buffett that the whole of Bitcoin is worth about $25.
Very controversial question. I'm going to answer it thus, that I think that people get a bit confused when they're talking about crypto, and I'm no expert on crypto. They get a bit confused because they lump it all in together.
Yes.
They're a bit, so blockchain is a fantastic invention, which
Agreed.
we're going to be, our grandchildren are going to be using when they buy a house, because
Yeah,
they,
sure.
get rid of all the paperwork. So that's tremendous. Now it happens that, the cryptos that run on the blockchain, but people do slightly confuse the two. So if you separate out, so just leave blockchain to one side, let's agree that that's a really good invention. With the currencies, the idea of having a currency which allows you to transact without touching the central banks is in itself a good idea. Okay.
Sure.
And secondly, if you believe that the metaverse is going to be big, and we can talk about that, but I think it will be probably. You can't spend dollars in the metaverse, and already
Sure.
$500 million worth of property is sold in the metaverse, which is kind of interesting because there's a literally unlimited supply.
Yeah,
So,
absolutely.
so when your real estate broker in the metaverse says, location, you can sort of slightly question that, because you can literally go off to another planet or whatever you do in the metaverse. But anyway, so the idea of a currency and an ability to transmit funds without touching central bank also makes sense.
Sure.
Trying to pick the winners from all of that and trying to value the coins is incredibly difficult. And if its major use is to allow the transmission of funds without touching central banks, then you need it to be stable.
Yes.
And the problem with Bitcoin is it's so volatile that you and I could agree a transaction, but by the time I send it to you, it could be 15% down or up.
Easy.
So it can't take over from these sort of fiat currencies for as long as it's that volatile.
Yeah.
Which defeats the object. The other interesting thing about it, I think, my point of view, is that most or a lot of transactions that are being done in some sort of crypto end up being translated back into dollars in the end, which completely defeats the object. I mean, that's not what it's there for. So I think I have no idea what the valuation of Bitcoin should be. I think investing in it is almost exactly the same as going to a casino and putting it on red. But I think that there will always be currencies which are going to allow you to transmit, without touching fiat currencies, and that's a good thing. And the blockchain's here to stay. So some part of it is all going to be great, but God knows how you make money in it as an investor.
Yeah, that's been harrowing.
Well, and look at the so-called stable coins pegged to the dollar, which are now worth less than $1. And look at the contagion that creates.
Yeah,
then the platforms, the crypto platforms, who everybody thinks, well, it's safe because you've got my crypto, and they're saying, well, we can't pay you out now because we're bust and we got your passwords. And the whole thing is there's a great story, you may have heard this, about a guy in California who has about he's got about $100 million worth of crypto, but it's on a hard drive on his old laptop, which he threw away. Okay, so he's lost the password. And if you can find his laptop, it's got the password on it. But his laptop is in a landfill in California, and he's been raising money from people to share the spoils of his 100 million if they can find it in the landfill in California. And this was like 5 years ago. They got to dig through 5 years worth of California rubbish to try and find it, and then plug it in and then hope it works.
Yeah.
And there's another really good story about a guy who has less, but he's still 20 million or something. And he's got one more password try left. He's used up all his password tries. And he's got one more try left. And once he does that, he's done. He's lost it forever. So anyway. Yes, sir.
From the floor.
How's it? My question is based around crypto as well.
Oh, God.
But given, I agree with you on the point of view that you don't want to buy into it because at the end of the day, it's worth what the market says it's worth.
Yes.
Very much like when we left the gold standard.
Yes.
Currency is only worth what the market says it's worth.
Correct.
So I do believe that you're making the correct choice there. But that being said, is there no interest in actually branching blockchain out to other technology, other services such as fund management and that sort of thing?
Yeah. So the first thing to say is this is not my specialist subject, but I'm very happy to talk about anything that I don't know very much about. The thing about I think you have to remember that when any new technology comes along, lots of people, the people who design the technology don't necessarily make money out of it. And then lots of people come along and try and sort of compete or add themselves to a list of people that are doing whatever it is. And it's deeply confusing for investors. And they have no idea which horse to back, if you like. Henry Ford went bust 3 times before his Model T sort of finally took off. And so I think that there's a difference between looking at these new technologies and thinking that's interesting and we're going to use that somehow and it's here to stay. That's a sort of adult view. The kind of adolescent view is, how do I make money out of it? And I think that's almost impossible to answer at the moment because it's so diffuse and there are so many pretenders, so many people, and you go past, I mean, almost every sports team now seems to be,
NFTs.
Yeah, NFTs, sports teams all trying to beg people by advertising to go onto their crypto exchange. And you've also got to look at the average crypto investor and think, are they really doing this to pay for their grandchildren's education? Or are they doing it to stop being a taxi driver? And I think it's just the Wild West. And you could only invest money that you're prepared to lose 100% of. And then you might get lucky, you might do okay. But the thing about blockchain is that it's hard to actually invest in blockchain. It's hard to find companies that do nothing but the blockchain because sort of by definition it doesn't need anything. It's just a big file. You don't need people to run the blockchain. So it's difficult. I think that would be a much easier investment if there was a blockchain co you could rush out and invest in. That would be good, but there isn't. So you're left investing in people using the blockchain, and some of those are cowboys. So that's why it's tricky. Yes, sir.
You showed that the depth in your nation do nothing.
Oh, the third step. Yeah.
Now, when Russia started pouncing on the Ukraine, I mean, you show in the next slides how over the last 2 years, basically Fundsmith have gone back a third.
Yeah.
Now, let's have a look at what the other risks could be. You said risk analysis, there isn't much that can be done. What happens if China does take Taiwan or Putin throws a nuclear bomb?
Right.
You're still going to do nothing because you've shown that we've lost a third.
Right.
Are we going to lose another third, or are we going to lose 80% of the 2/3 that are left?
Right.
So the question is this the right policy? I mean, or do we have to now get in and say fundsmiths are going to lose us if something happens on that front, at least another third or 80% of the rest that we have?
Right.
Because the situation is very fluid, and I don't think you can just sit there doing nothing.
Right. Okay.
Thank you.
Well, that's a very fair question and a fair view. So the issue with equity markets in general is that...
Sorry, Greville, can I just jump across? Just if there is load shedding now, we're just going to come back on in a wee bit. It'll be like a minute or whatever.
Yeah, that's fine.
But also for the online guys, it'll literally just reboot. So not to worry.
Yeah,
sorry,
no
carry on.
So the answer to your question is equity markets in general. If you look at a chart of all the equity markets, they go up over a long period of time, but they don't go up in a straight line. There will be periods where bad things are happening in the world, where share prices will come down. Now, as I was saying earlier on, the only thing that we really care about is whether our businesses are impacted by whatever's going on. And the answer, so to your question, we're sure that the day that Russia invaded Ukraine, people were still feeding their dogs and they were still brushing their teeth and they were still using makeup and they were still putting their photos up into the cloud and so on. For as long as we believe that our 29 businesses are doing fine, then we believe the best return we can offer to you, the investor, over the next 10 years is not trying to jump in and out of the market, because we just are not good enough at doing that. We don't think anybody is, but that's up to you or up to them. But so long as we know the companies are growing, we think that, and so long as their business is not being adversely affected by whatever it is that's going on, then we believe you get a better return by not jumping in and out of the market. Now, when you say, well, is it going to go down another third if China invades Taiwan? It's eminently possible, but that's the risk that you take in the equity market. You get a higher return in the equity market because there is risk attached to it. And unfortunately, you can't have that sort of return with no risk at all. That doesn't exist. Again, if China invaded Taiwan, we would still be pretty confident that people would still be logging onto their Microsoft servers and they would still be feeding their pets and washing their hair and drinking whiskey. So we don't think our businesses would be terribly badly affected by that. Would the stock market prices go down? They would, yes. And ours would as well. But we still believe that if you're a long-term investor, you get a better return not trying to anticipate what the market's going to do, jump out at the top and back in at the bottom, because nobody's been able to do that. If one is concerned about macro events such as the ones that you're saying, then the best thing to do is not be in the market. You know, you should, I'm not saying you should, but if you think there's a high chance that risky things are going to happen in the second half of the year and the stock market's going to go down another 25%, the best thing for you is to just come out of the market. And then when you think the world looks like a happier place, to come back into it. But that's not something that we do because we know we're not any good at that. Long term is 7 to 10 years, we think. We don't really want anybody to give us money who's thinking on a shorter period than that, because we're not aligned with you on that basis. So we believe these businesses are going to be very good over that period. We think they're very good today, but our investment horizon is of that order. If a friend of mine sold this house the other day and said, I want to put the money in the fund, and I said, you're going to buy another house? He said, yes. I said, when? He said, you know, within a year. And I said, then please don't put your money in the fund. And he said, well, why not? And I said, because I've no idea what the price of the fund's going to do in the next 12 months. And you're going to be annoyed if you want to buy a house and it's going to be a smaller house because the fund's gone down 10%, because the stock market's gone down 10%. But I said to him, if you're not going to buy another house and this money is for your grandchildren's education or something, then give us the money for 7 to 10 years, but not for a time period less than that.
Steve?
Yes, sir. You were in New York and people are buying, spending. Yes. So that affects some of the funds that you're in. So this is a good time to jump into Fundsmith.
I'm not your wealth advisor, so I'm not going to give you advice on when to buy. If we're doing the right thing, if we are truly invested in 29 great businesses, which for the next 10 or 20 years are going to grow and compound, then I would say there's never a bad time to get into this, even at the end of last year. And even if you've lost 15% so far this year, if you believe in what we're doing and you think we're doing it in the right way, then to be brutally honest, the timing won't make much of a difference. Because if we're going to be able to compound, then South Africa, the UK, US, and Luxembourg, of those 5 jurisdictions, up to January this year, the only regulator who had visited us was the SEC in 2016, and they said everything was fine. So it wouldn't be a shock to us if we got a visit from any of the other regulators, because, and particularly in the UK, where we're running the largest fund in the UK, you would think they would want to be triply sure that everything that we're doing is correct.
Yeah.
In the UK, we had this big failure in Woodford,
Yes.
and the regulator was completely asleep at the wheel and had no clue what he was doing. And I think that there's a lot of political pressure to make sure that never happens again.
Right.
So although I can't confirm or deny that the regulator's been to see us, it wouldn't be surprising to us if that did happen at some stage. Were we ready for it? It's a bit like the Monty Python sketch, the Spanish Inquisition. Nobody expects the Spanish Inquisition. If it came, would we be ready for it? Well, actually, we've our CFO, Simon Godwin, retired about, he told us 2 years ago he's going to retire. And he was the CFO, the head of operations, and the head of compliance. And what we did was, as he was leaving, he said, by the way, I think it probably makes sense for you to build those out as separate jobs now that Fundsmith's big enough. So we hired a new CFO, a new head of operations, a new head of compliance, and each of those guys in the last 12 months have hired sort of teams of people. So we've got a morass of compliance people at Fundsmith and operations people and financial people. So we hope that we would be well able to cope with any sort of visit.
Yeah.
And also, I think that, I don't know how to put this quite, but it always strikes me that the companies that are most likely to be cutting corners on regulation are those that are not making very much money with, terrible funds, not very many people and terrible businesses, and they can't afford to. So if you are lucky enough to be Fundsmith and you've got a good business with a big fund and lots of investors, and you know that you're on the spotlight because you're the largest fund in the UK, and Terry, you've met him several times, it just wouldn't seem like we were the most likely candidate to say we don't really need to fill in that form, this year.
Yeah.
We don't. Or let's not bother about hiring a compliance person in Mauritius. Let's just wing it. It's just it's not who Terry is or how we would be as a business. So I think and hope that if that took place, that it would be fine. I mean, if the press speculation about it is correct and the timing was correct, it would have all finished by now. So if we're still here, they must have found that everything was sort of okay-ish.
The press were implying that Terry earns too much money and has too much control. Is that
the press are implying that he has too much money, earns too much money, and he has too much control?
Yeah.
Well, I know that's a very controversial question, actually. I mean, does he have too much control? Well, I don't think he does, because there's a management committee that he sits on. But actually, in the portfolio sense, he spoke out at our AGM about not liking Amazon. And one of the analysts wrote a big piece saying, I think we're looking at this in the wrong way.
Yes.
And Terry said, you're right. And we bought it afterwards. I only mention that because I think a lot of people think that, Terry's never challenged, or nobody sort of says to him, we should do this and don't do that. It's just not true. I mean, within the business, you can challenge him. Within the portfolio, you can as well.
Yes.
So I don't think he's got too much control. Does he make too much money? I don't know. I mean, sort of, by whose definition?
Yeah. Well, not Elon Musk's.
Yeah, I mean, it's a fund management business. We charge the same fee, had from the day one. If people think the fee's fair, that's great. If they don't, then that's fine too. It's just sort of, it's always been the same. But I mean, effectively, people are paying either 0.9 or 1% for a 16%, sterling return for the last 11 years, and that 16 is net of the 1.
Yeah.
So, is 16% a decent return, paying 1% somebody to do it? That's up to the investors to decide.
Sure. Just an additional one, why Meta and why Amazon?
So Amazon, let's talk about Amazon first. So we didn't like Amazon because we don't like retailers. Retailers have very low margins around the world. In fact, there's a thing, I was using a quote earlier today from Target, the US retailer, which Target's gross margins were in the first quarter when they announced them. We don't own Target, we never would, but Target's gross margins were reduced by 4.5% because of higher input price, from 30 to 25 roughly. And their operating margins were down from 10 to 6, roughly, 5.5. And that reduced their operating profit by 43%.
No, sure.
And that's why low margin businesses are so difficult to invest in, because you get carted out with a small change. And that's why I spend so much time today talking about high margin businesses and how it's much better to be invested in them. So we don't like retailers. And in Amazon's case, it's not only a retailer but they're also delivering the stuff to you for nothing. So that reduces the margin even more.
Yeah,
so there's nothing about that we like as a business. But what the analyst wrote is that they now sell more third-party stuff than first-party stuff. And that's a much better business, because on third-party stuff, you can charge whoever for whatever.
Yeah.
So that's a much higher margin business. So that's good. Their cloud business has always been good. We love that. Yeah. And then their prime business is very good. So they make money, a lot of money out of the membership, not so much money out of the selling the stuff to the membership, but just the pure membership is just a fantastic cash cow. So we like that. And then the last thing is Apple changed their software, iOS 14, to stop this cross-app tracking. And that made Amazon's advertising business, which was quite small at that stage, much more interesting, because we are giving Amazon a tremendous amount of information every day, because they can see that I bought batteries yesterday. Now I'm freely giving that information to them. I can't say you can't use this information. I gave it to them.
Yes.
And so Amazon now has this amazing data set of what we're all doing with our lives. So for advertisers, that's very attractive. So Amazon's advertising business is its fastest growing business and its most profitable business.
Sure.
So we changed our mind on Amazon and bought it. In Meta's case, was that the other one you asked about?
Yeah.
So Meta is just a giant advertising company. If you think that advertising is going to continue to move from TV and radio and magazines and newspapers online, then the two ways of playing that are Meta and Alphabet, you know,
Yeah,
Google and
simple.
Facebook. And if you set up a little neighborhood business here doing anything, you will use Facebook to advertise to the community because there's no other way of doing it.
Yeah.
And so Facebook, Instagram, and WhatsApp have about 2 billion users each. And there's no obvious competitor in the Western world. It's a monopoly, really.
Absolutely.
You know, TikTok doesn't really compete with Instagram, although people think it does, or Facebook for that matter. So you've got this giant monopoly business, which is growing at 20% a year or something, which is only about 7 or 8 million companies use Facebook to advertise, but 70 million have a Facebook presence. So all they're doing every year is just converting some of those people and making them into paying guests, essentially.
Yeah.
And that'll go on for years. So if you think online advertising is here to stay, then you've got to own Apple or Alphabet or Meta or both, and we own both. I mean, quickly, a word about the metaverse. I think people think that Zuckerberg's going off down this huge tangent in building the metaverse, but he's not, because it's already upon us. And anybody who is an avid gamer or whose kids are avid gamers are essentially already living in the metaverse.
Absolutely.
And they're using tokens and coins and fake money and so on. So all he's really doing is making it a bit more comfortable, you know. But what's interesting about the metaverse is that other big tech companies have started talking about it. So Microsoft mentioned it last week, and Apple mentioned it last week. So it's not a sort of a Zuckerberg, Facebook, you know, let's go to space idea. It's something which we're all going to use, and we're all going to be sort of absorbed into it in some way. And it's just that he's got first mover advantage because he started first. So we don't own it because of that. But I think some people say to us, why didn't you sell it because of the metaverse? It's like, because the metaverse could be transformational, you know.
Absolutely.
I mean, I think this is just me talking, not Fundsmith, but one of the reasons why I think metaverse is going to be huge is because I think there are a lot of very unhappy people in the world. And if you're deeply unhappy in your job, you know, and at home, and you work in the post office or something, and you go home, and then
The South African post office, you'll definitely be unhappy.
Okay, South Africa, okay, you work in the South African post office, you're completely miserable. You go home, you put your goggles on, you're in Hawaii, and you've got a gorgeous girlfriend or boyfriend or something, or family, and you've got, you know, you sit and you've got dogs and cats, and you've got a beautiful house that you built, and you're surfing with your goggles on or something. I mean, it's just, people are going to live in that world. They're not going to live in the post office in South Africa. It's going to be this escapist kind of, that's what I want to do, I think. But I mean, what do I know? I have a lovely life, so I don't need the metaverse.
You're in Mauritius.
I live in Mauritius. I'm ready the metaverse. Mauritius is the metaverse. But anyway, that's Meta and Amazon. That's why we own those.
Anything else? Is everyone ready for a drink and something to eat? Thank you very much for attending. Thanks very much for the great questions. Please join us for drinks and snacks afterwards. Thanks, Greville.
Perfect.
Really appreciate it.
Thank you. Nice to meet you.